Today we talk REITs.
Welcome to the Rent Investing Podcast, the ultimate property podcast that unpacks the facts and explains what's really going on in property. Learn how to live where you want, but invest where you can afford with your hosts, Louis Strange and Jaden Vecchio.
Hey guys, and welcome to this week's episode of the Rent Investing Podcast. I'm Jaden.
I'm Louis.
So this week, we're talking about something actually a bit interesting, Louis.
Yeah, a bit of an alternative.
So they're sometimes called alternate assets, actually, but it's ways of buying property without actually owning it.
Yeah, so if you want to start investing, but you've only got a few $100 or $1,000 or so, and you're after property, there's some little alternatives. Rather than saving for the next 10 years to actually get a deposit to buy that property, you can actually get into property now.
Or even as a way to invest your deposit while you're saving up to buy property.
Yeah.
So that's pretty cool. So without any further ado, let's do it.
Here we go.
All right, mate. Well, so how do you buy a property without owning it? Because that sounds super scammy and spooky.
Sounds like an upside down triangle scheme, but there are actually structures out there to allow you to, for as little as $100 in some cases, purchase into property without actually owning it. So we'll run you through the two types. One's called a REIT. So REIT stands for Real Estate Investment Trust. It's one of those little acronyms that, again, finance people love.
Like REIT, LVR, whatever. Are you REITs or AREITs or?
So all that a REIT is, in a pretty simple definition, is a trust that owns property. So a trust is just a structure similar to a company in a way. So one trust might own 20 different commercial properties, and rather than you buying the whole trust, you just buy some units from them. So it's similar to a share. Rather than buying shares, though, you buy units in these structures. So in Australia, we call AREITs REITs.
So Australian Real Estate Investment Trust?
Yeah, exactly.
Nailed it.
So there are a few types, but majority of them in Australia allow you to invest in commercial properties, in industrial parks, in retirement villages or aged care facilities. There's a lot of different property or commercial investments that you can make rather than just your standard residential.
And they're usually bigger as well because, you know, if you're investing in a commercial property, if Louis goes out and wants to buy a shopping centre, you need a 35% deposit plus experience. It's a different skill set. So these give you access to those assets without having to stump up $30 million for a shopping centre. You can invest change.
Yeah. So that's the whole concept, and that's why they came into fruition, because people would want to get into property, start buying property, but it's pretty hard to get that initial deposit ready to enter into property. So it allows you to scale through basically pulling all your funds together with someone else and investing into a vehicle that allows you basically to all throw that $100 in there. You get 10,000 people throwing $100 in there, and then someone can purchase a property inside that trust.
So, and practically, what do these look like? So there's like, I know Westfields have got REITs where you can invest in their shopping centres. Yeah. There's, what other things do you see typically, like infrastructure?
Yeah, so on the Australian Stock Exchange, the major ones, you've got Centura Group, Stocklands, Westfield. So they're listed as shares, but when you actually buy those shares, what you're buying is the underlying interest that Westfield has. So say, for instance, 50 shopping centres around Australia, you could get a share in Westfield and have a very, very small proportion of all those shopping centres. So being a shareholder then, you'd be entitled to the rents and any capital growth that those properties get.
Yep. And then so working through, then you can have, there's unlisted REITs where they might have specific one asset in there. So there might be, I don't know, 1, 2 and 3 corner shopping centre at Corinda where you own that little set of shops or own a share in those shops.
Yeah. So unlisted, they aren't on the stock exchange, so you can get small little private REITs that are selling 1 or 2 properties inside a trust. There's a bit of a risk involved with those because they're pretty liquid. So liquidity is just how easy it is to get your money out.
So it's not like being on, you go on your share trading ComSec or eChoice or whatever, and you just buy and sell out of that Westfields or whatever stock.
Yeah. So you can get your money out of that in 2 days or so. But a unlisted, Sometimes you can't get your money out for months. So in a fund's mandate, it will say we have the discretion to hold your funds for up to 6 months if you ask for them. And what we saw in the GFC is all those funds got frozen. So rather than obviously when things are going down, everyone wants to get their money out. So everyone went to get their money out, but because all these properties are hard to sell and all people's money are tied up in these properties.
Yeah, so selling a $30, $40 million commercial warehouse, retail, an office tower.
So people couldn't get their money out. So what these funds did is just froze the assets and then over time drip fed the funds rather than, say, for instance, doing a fire sale on the property, selling them for $200 when they're worth millions. In a way, it was good. It was protecting the capital of the people who had invested, but also bad because those people couldn't access that capital. And the value of the investments obviously went down over time. So that's a bit of the risk with REITs. If they're listed, they are fairly volatile, which means they can go up and down a lot just based around sentiment of property. If people think property's going really well, they're going to go really well. If people think property's going down the toilet, these REITs will actually go down the toilet. And we saw that again in the GFC. Even the listed REITs on the exchange, they dropped around 70% for some of them.
Ouch.
So it was off the back of a big build-up, but then, they crashed very hard just in a very small period.
And then, so that's obviously some of the depressing parts about REITs. Well, what's the happy sun time upside of REITs, and why would you invest in them?
Yeah, so the happy upside fun time is that you get access to property. So if property's what you're looking to invest in and you don't have enough funds, you can actually get access to a lot of different and diversified properties. So
you don't need your 20% deposit and stamp duty and all that stuff to potentially buy property or invest in property.
You just give them $1,000. They'll then allocate that $1,000 as per their 20, 30, however many properties they have. So you might have, in the end, a $20 or $30 stake in each of their properties. But off the back of that, you're entitled to all the rent that those get. And especially if it's commercial property rather than residential. Commercial, by a bit of a rule of thumb, often costs a bit more in rent. So you get a better yield.
And it's usually indexed with CPI. So typically commercial rent will go up year on year.
Long-term contracts as well. Those little things play into that viability of owning a REIT in commercial property rather than a REIT in residential. And also you can actually target the market that you want. So if you want some healthcare facilities, you can actually buy essentially retirement villages. So it depends on the thematic trend you're going for. If you think retirement villages are going to boom, you might want to get into those and very cost effectively get into that.
And I think the other part that I like is you can invest globally and you're not restricted to Australia or Brisbane or Sydney or wherever.
So
talk us through that.
If it's an AREIT, obviously it's an Australian one, but you can actually get global REITs as well. So
are they called G-REITs?
No, damn it. They're called REITs. You can get them basically in a lot of different countries globally. So
same thing. You can own a highway in Thailand or a bus station in Manila. I don't know.
So even in my super, I've got a few AREITs. Rather than going out and buying more property personally, I just thought I've got a few thousand lying around here or there. I'll go buy some property in Australia and some property internationally, just inside my super fund. So you can access a lot of these just through a wrap platform or online platform that allows you different investment choices as well.
It's the thing wrap is in like M&M or something, but it's not. It's a cash management platform.
Add a little W on the front.
Okay, mate, so I guess rounding back to the top. Oh, no, you still got more?
We've got more.
Whoa, go on.
There's more. There's also infrastructure. So not only can you invest in these things called REITs, which buy different types of properties, you can invest in infrastructure funds. So that's the second type of investment that allows you to get into big projects or property-like quasi-investments.
So it's like Bridge Connects or like tunnels and that sort of stuff.
Most of the time, whoever's managing the funds will look at a number of things. If it's government legislated contracts, that's a big win.
So it's typically where the government needs to put in a new bridge or tunnel somewhere and they don't have all the money. So they think, well, give it to the private sector.
Yeah.
That's kind of how it works.
Exactly. So infrastructure globally is quite a decent investment. Comparing to the REITs, to my infrastructure investments, the volatility, so the movement in infrastructure is far less. And that's because it's sort of seen as a more defensive asset than commercial or other properties. So let's take this example. GFC happens, everyone's shutting shop, businesses are closing, they're either moving overseas to reduce costs or just shutting completely. So commercial properties, their tenancy goes down, returns fall.
People aren't buying in the shops or...
Exactly. So sentiment goes down a bit, but with infrastructure, people still use train lines, toll roads, power, all the basic essentials of life. So they're seen as more a defensive property allocation just for the fact that they're not as volatile, but they still give very good returns. And then sometimes, say, I think the name of the company's Edamine. It's probably totally wrong, but it's the company in charge of the US shale gas process. So they've got one pipeline going from up in Alberta in Canada all the way down to Florida. So pretty much diagonally across the country. And they've got I think it's 10-year legislated income from the government at ridiculous rates just to pump all the shale gas down to the processing plants in Florida. So those sorts of investments, if it's inked, it's probably pretty safe that it's going to continue.
It's underpinned by the government and just to do with bonds and different...
Unless the US goes bankrupt or Trump gets in or something happens.
And it's all over.
So yeah, that's the second side. If you're more defensive in nature, infrastructure could be a better choice.
Cool. Want to wrap it up?
So if you're looking to buy a property without actually owning it or start investing in property but you don't have enough capital to do so, look at REITs. So if you're looking to get into those, you can jump on Google and if you type REITs and ASX, the Australian Securities Exchange, it will come up with a list of all the ones that are on the exchange, or you can just, again, Google infrastructure funds. There's Macquarie or Magellan, a few big investment managers that have some actually decent infrastructure funds as well.
Cool. Till next time.
See you guys.